Hello students, today we will be studying a very important topic, that is bonds, and we can usually see a question on bonds whether in our PhD entrance exams, or we can see in NAT or SLET if you go through the previous year question papers. So let's start with the topic. So what is bond? Okay, bond is a debt security, you can say. So if it is a debt security, that means what? We will be getting a fixed income in those securities, and that fixed income will be in the form of interest. Okay, we will be getting an interest on those securities. So now the question is that what is bond? Yes, it is a debt security. We get a fixed income in the form of interest, and if those security is being issued by the government or a public sector unit, it is known as what? Bond. If the debt security is being issued by a private company or a joint stock company, then those debt security will be known as debentures. This is only the difference, that if a debt security is being issued by the government or a public sector unit, it is known as bond. If it is being issued by the private company, it is known as what? Debentures. And we get a fixed income in here in the form of interest. So in case of a bond, the interest which we get is known as what? Coupon rate. Coupon rate is the rate of interest which is payable to the bond holder by the issuer company, whoever is the issuer company, the government or the public sector unit. If they will have to pay a fixed income, right? And that fixed income will be in the form of interest, and that interest is known as what? Coupon rate. Okay, it is the rate fixed, and that interest rate will be written on the bond certificate, that this is the rate of the coupon rate for the bond. Okay, for this bond, this is the coupon rate, say 12% or 10%. This is the coupon rate. Yes, so that will be the interest which the bond holder will be receiving, right? So I hope it is clear that what is a bond and what is a coupon rate. Now moving on to current yield. In simple terms, if you want to understand what is current yield, we can say it is the expected return on a bond. The expected return on a bond by a bond holder. Okay, and to find out the current yield, the formula is annual interest rate divided by the current market price into 100. So we can define the current yield as it is the annual interest rate, interest receivable on a bond to its current market price. Yes. Now let us see an example that how to find out the current yield. Yes, listen to me very carefully. Say we have a bond with a face value of say 1000 rupees. Okay, and the coupon rate is 12%. Yes, and the bond is selling at a discount. Yes, at a discount of rupees 800. The selling price is 800, the face value is 1000, and the coupon rate here is 12%. So now if we want to find out the current yield, how will we finding? We all know we find the annual interest rate on the face value. That means the coupon rate into face value. So the coupon rate is 12% into face value. Face value is 1000. We get 120. Yes, so annual interest rate is 120 divided by the current market price. The current market price, that means it is selling at which value? At rupees 800. Yes, so 120 divided by 800 into 100. So how much we will be getting? We will be getting 15%. So our current yield is 15% in our example, and the coupon rate is 12%. So in our example, the current yield is 15%. That means it is greater than the coupon rate. Yes, if the current yield is greater than the coupon rate, that means the bond is selling at a discount. And yes, it was selling at a discount. The face value was how much? It was 1000, and it was selling at rupees 800. Yes, so through our example, we have proved it that yes, it was selling at a discount. If the current yield is greater than the coupon rate, the bond will be selling at a discount. Because our current yield was 15, we got it as 15%, the coupon rate was 12%, so 15% is greater than 12%, that means it is selling at a discount. The bond is selling at a discount. It was face value was 1000, now we have the selling price is 800, that means it is selling at a discount, right? Sorry, I'm repeating it. I hope you all have understood it, right? And if the current yield, say it is current yield is now say 10% and the coupon rate is say 15%, that means the bond is selling at a premium. Yes, and if the coupon rate is the current yield is equal to the coupon rate, the bond will be selling at a par value. That means in our example it was 1000. Yes, it will be selling at 1000 rupees only, par value. Yes, so I hope it is clear. Current yield topic is clear. Now moving on to another topic. Bond pricing theorem was given by Burton G. Malkiel, and in this theorem he gave 5 principles, and it states that the relationship between the bond price and the market interest rate. There is an inverse relationship between the bond price and the market interest rate. Very important. There is an inverse relationship between the bond price and the market interest rate. See, when a bond is first issued in the market, it is issued at the current prevailing market interest rate only. That means the coupon rate is equal to the market interest rate prevailing in the market. So it is 10%, 10%. Okay, market interest rate is 10%, so the coupon rate will be 10%. But as time passes on, the current market price will be changing, right? The interest rate keeps on changing. So let's say it have increased. Yes, it may increase, it may decrease. It have increased now, example say now it has become 14%. That means the current market interest rate is greater than the coupon rate which we are receiving from the bond. So the bond becomes less attractive. As the bond becomes less attractive, the bond price, it decreases. Okay, that means we can say when the market interest rate is greater than the coupon rate, the bond price decreases. Okay, because it has become less attractive now. And if the market interest rate is less than the coupon rate, what will happen? The bond value will increase. It will be sold at a premium. Yes, if the market interest rate is less than the coupon rate, say market interest rate is 10% and the coupon rate is the coupon rate was 10%, right? The coupon rate is 10%, the market interest rate is say 8%. Yes, it is less, so the bond will be sold at a premium. The bond value will increase. Understood? Clear? There is an inverse relationship between the bond price and the market interest rate. If the market interest rate is greater than the coupon rate, the bond value will decrease, and if the market interest rate is less than the coupon rate, the bond value will increase and will be sold at a premium. I hope it is clear. And the other theorems are that this is the first theorem, okay, and the second theorem is that the bond price variability is directly related to the maturity. That means the longer the maturity, the change in the bond price is greater. Okay, and next, third theorem is that a bond sensitivity to change in the market interest rate increases at diminishing rate as the time remaining until its maturity increases. Okay, fourth theorem says that the price change resulting from equal absolute increase in the market interest rate are not symmetrical. That means the price change is not symmetrical. If there is more change in the market interest rate, the price change may be less. Yes, or it may be equal also. Then fifth theorem says that the bond price volatility is related to the coupon rate, which implies that the percentage change in the bond price to change in the market interest rate will be smaller if the coupon rate is high. That means if there is a change in the market interest rate, okay, and the coupon rate is higher, then the market interest rate change will be smaller. If the coupon rate is low, the market interest rate change will be larger. Okay, I hope it is clear. Bond comprises of two risks. One is the default risk, another is the interest rate risk. Default risk is when a company is not able to pay the interest money or the principal money, that is known as what? Default risk. Yes, very simple. Now, interest rate risks comprise of two risks: reinvestment risk and price risk. Okay, say I'm holding a bond and the coupon rate of the bond is 10%. The market interest rate of the bond, it increases, say it becomes 15%. Yes, so what I can do, from the annual interest which I will be earning from the bond, I can reinvest it. Yes, I can reinvest it, the annual interest, and I can earn a higher rate than what I was expecting. Yes, I'm earning a profit here, right? But on the other hand, we know that there is an inverse relationship between the increase in the change in the market interest rate and the bond price. Here the market interest rate was increasing, it had become 15%, and the bond coupon rate was 10%. That means the bond price will decrease because the market interest rate is greater than the coupon rate. Yes, so the bond price will be decreasing. When we will be selling it in the market, we will be selling at a less price. That means we are earning loss in here. So if the gain, the reinvestment gain, is less than the loss which we have incurred on selling of the bond, then in total we will be earning a net loss. Yes, so this is known as what? Reinvestment risk or price risk. Thus, because of the rise in the interest rate, yes, there we have to incur reinvestment risk as well as price risk. Yes, it may be the other way around also. If the market interest rate moves down, the investor will be able to reinvest the interest at a lower rate than what we are expecting. Yes, but the bond price will move upwards. Yes, and as the market rate have declined, so the investor losses on reinvestment of interest, but he gains on selling of the bond. Now let us see duration of bond. Duration of the bond, that means when the interest rate risk of the bond completely disappears for that duration, therefore it is known as what? Duration of the bond. That means the loss on reinvestment is being compensated by gain on selling of the bond. That is known as what? Duration of the bond. That means in the holding period, when the interest rate risk of the bond disappears, that means it is being compensated by the loss on reinvestment is compensated by the gain on sale. The holding period is known as what? Duration of the bond, when there is no interest rate risk. I hope it is clear. Thank you, my dear students. Do like, share and subscribe to my channel, and let me know how did you like the video, and if you want me to make new videos on any topic, let me know in the comment section. Thank you.